Please welcome to the stage, Doug Kearing.
I think Larry used the magic word, upside. So I'll be presenting our updated financial outlook, which I think everyone's been anxiously waiting to hear. But let's start off with the usual exciting stuff that Ken went over earlier. You know, it's funny, now that they're asking me to certify the financials, this actually means a lot to me, so please pay attention, okay? This one reminds you about our forward-looking statements. And this one is reminding you that we'll be using some non-GAAP financial measures in my presentation. Okay, you've heard the strategy throughout the day from Larry, Clay, Mike, and the rest of our management team. We have an unbelievably strong and deep set of enterprise technologies for both cloud and AI. And we have the vision, leadership, and experience to execute this. It's now time to see how all of this impacts our financials. Building on our long-term expectations can be boiled down to a few simple steps. First, we work extremely hard to turn the customer momentum we are seeing, as evidenced by the amazing enthusiasm you've seen here at AI World, into an accelerating RPO backlog. Second, we then deploy our operational expertise to provide capacity to customers that help us turn that backlog into accelerating revenue growth. Third, we leverage this growing footprint, scale, and the utilization rates of our data centers to turn this larger revenue into profit growth. And the result is that we are raising our long-term financial outlook again. I'm going to quickly walk you through the process of how we arrived at these new figures. The best way to think about Oracle these days is as a hypergrowth company. Our remaining performance obligations, or RPO, is the clearest indicator of the revenue that's about to come. As we announced on Q1 earnings, we highlighted two things on this topic. First, that our RPO balance now exceeds $455 billion, up 359% year over year. And second, that we expect RPO to likely exceed $500 billion. In fact, already through the first month and a half of Q2, we've signed several additional large contracts, as Clay mentioned during his presentation, which put us over the $500 billion mark. The demand we are seeing is really hard to comprehend. To put it in perspective, our RPO balance is up nearly 10x since fiscal year 2022. Clearly, the customer demand is strong, but it's also enduring. The biggest impediment to growth right now isn't so much finding customer opportunities, but rather executing on these opportunities by converting that demand into revenue as soon as possible. As our data center operations engine has revved up and we've become more experienced at it, we are bringing on capacity faster and faster and with more efficiency, as Clay discussed earlier. The ramping has already started, as you've seen over the last couple years, with cloud growing as a percentage of total revenue from 20% in FY20 to 44% in FY25. As cloud crosses the 50% mark as a percentage of our total revenue, the revenue growth rate is further accelerating, as evidenced by the forecasted 16% growth rate for fiscal year 26. To put this growth rate in perspective, the last time Oracle grew this fast organically was over 15 years ago. As well, when you look at the expected revenue growth rates over the next 12 months, for companies in the S&P 500 with more than $50 billion of revenue, there are less than 5 companies growing faster than Oracle. And we aren't even close to seeing the peak growth rate yet. As our revenue begins to accelerate, so does our operating income growth. The reason is that our pricing discipline, coupled with scale efficiencies, enable us to gain significant profit leverage as our revenue grows. As the utilization rate of each data center increases, they contribute more profits. And the rest of our operating expenses have grown much more slowly than revenue, also helping further our profit growth. Now, before I turn to the updated financial outlook, I wanted to revisit the figures that we presented at last year's financial analyst meeting. As you may recall, we announced last year our expectation to reach over $100 billion in total revenue by FY29, nearly double the revenue from FY25, while simultaneously accelerating our profit growth. But that was last year. As we dive into this year's outlook, I want to start by explaining what is guiding us as we work to deliver the financial outlook that I'm about to share. First, every customer is put through the prospect of the lens of both a revenue opportunity and a profit opportunity. I've read a lot of stories that are speculating that Oracle is chasing revenue for revenue's sake. But let's be crystal clear. We only pursue opportunities where we have a clear line of sight to attractive margins that reward us for our intellectual property and the activity we bring to customers. Second, as we work to build capacity, we are pursuing a range of financing options to support our growth. We pay careful attention to our cash flow, our debt ratings, our debt capacity, and the various funding mechanisms that are at our disposal. These all factor into how we strategically grow revenue and profits faster. Third, we are working diligently to constantly match our expenses as our revenue ramps in our data centers. This operational discipline is critical to be able to deliver profits to our shareholders faster. And fourth, our overall cost focus on every aspect of the company will help us deliver higher profits from our revenue base. That has not changed, and it will not change. And finally, if all of this works in harmony, as we expect, the result is superior investor returns for our shareholders. So here goes. Clay showed you earlier our updated infrastructure revenue targets, which are even higher than what we shared on our Q1 earnings call. Building on that, along with the RPO backlog that we've already signed, the customer opportunity pipeline, and the strength of our competitive differentiators, we see much more revenue upside in the next 5 years than just a year ago. Our updated revenue target is to reach $225 billion by fiscal year 2030. This represents a CAGR of over 31% over the next 5 years. Our pipeline is very deep, and we could see more large-scale opportunities signed over the next 12 months, which could change this forecast and outlook further. And in terms of profit growth, we forecast reaching $21 of EPS by fiscal year 2030. This represents a CAGR of 28% over the next 5 years, consistent with my comments that revenue and profits are symbiotic. These figures are stunning, with both revenue and EPS growing nearly 4x over the next 5 years. Now, before I turn it back to Larry, Clay, and Mike for Q&A, it's important to note that these figures are as of this moment in time. If we see additional demand that enables us to grow revenue and profits faster, we will accelerate near-term investments in order to capture additional market share. As Larry recently said, quote, AI is a much bigger deal than the Industrial Revolution, electricity, and everything that has come before, end quote. We are extremely well positioned for this opportunity, and we will pursue more growth so long as it fits our profitability expectations. Thank you.